Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the numbers that companies put out. Today we're diving into the latest annual report from PAMT Corp, and let me tell you, it's a bit of a bumpy ride. We'll see if this trucking and logistics company is delivering more than just goods, or if their profits are stuck in gridlock. Alright, let's get started. This report is their Form 10-K, basically a yearly checkup that every public company has to do with the SEC. It covers everything from how they make money to what could send them off a cliff. It's like a year in review, but with more jargon. PAMT Corp, formerly PM Transportation Services, Inc. is in the business of hauling stuff, plain and simple. They own subsidiaries that do truckload dry van carrier services. If you've seen a big rig on the highway, chances are they're involved. They ship all sorts of goods all over the continental United States, Mexico, and even into Canada. Think automotive parts, retail goods, and manufactured products. They have both company-owned trucks and agreements with independent contractors. It looks like about 38% of their business is cross-border Mexico and Canada. Now, even though they have a few different ways of moving goods, they keep their accounting pretty straightforward. The company's operations are aggregated into a single motor carrier segment. Here's a scary thought if you are PAM. They rely heavily on a few big customers. About 39% of their revenue comes from their top 5 clients, and General Motors alone makes up about 12% of their revenue. If they lost just a couple of these big accounts, it could really hurt them. They also haul for other auto suppliers, and all that auto business makes up almost a third of their revenue. This dependence on the auto industry is one of their weaknesses. Time to look at the risk factors. Every company has to list all the things that might go wrong. One thing that stands out is tariffs. If the United States raises tariffs on goods from Mexico and Canada, or vice versa, it could mess with their cross-border business. Also, they worry about attracting enough drivers, fuel prices going up, and the used truck market going down. Of course, like everyone else, they face cybersecurity threats and have to protect their data. So far, they haven't had any massive breaches, but they know they're a target. Now, let's dive into the numbers. I will just cover the highlights because otherwise we would be here all day. This shows what the company owns and owes. Think of it as a financial snapshot. Accounts receivable, net, the amount of money owed to them by customers decreased slightly from $80, $6 million, $9 million. This is not a major red flag. Here is a big one. The company's property and equipment grew from $771 million to $831 in trucks and facilities. Long-term debt increased quite a bit, going from $2,442, so they are on the hook for a lot. Alright, let's move over to the income statement. This tells us how well the company performed over the last year, showing revenues, expenses, and ultimately the profit or loss. Looking at the operating revenues, revenue before fuel surcharge decreased from $706 million to $629 million. This shows that business slowed down for them. Now, this depreciation line jumped significantly from around $64 million to over $99 million. That can indicate that their equipment is getting older, or they change how the equipment useful life is measured, as we will discover later. This is a bit of a red flag here. An impairment loss means they had to write down the value of some of their assets because they weren't worth as much as they thought, and that happened on certain trucks and trailers. The big number, the bottom line, net loss income changed from an $18 million profit to a $31 million loss. I'm sure they weren't happy about this. The last point I'll point out for the income statement is that the diluted earnings per share fell from a profit of 83 cents to a loss of $1.45, meaning the company is underperforming. Let's take a look at the cash flow statement, which shows how cash moved in and out of the company. They generated less cash from operations, $59 million compared to $114 million the prior year. They are still investing by buying a lot of property and equipment. The report said that over the long term, the company will require them to incur debt or seek additional equity capital. They believe that they will be able to get the job done, but there is a risk they might fail. The biggest accounting item was depreciation and amortization, and the company said that for the review ended in 2024, the company reduced estimated useful lives of trailer equipment and lowered estimated salvage values of revenue equipment to better reflect their expected residual values at the end of their service periods. I mentioned this earlier because this also contributed to their change in profit and loss. They did this because market conditions changed and market conditions warranted changes for their estimates. Here's the good news. The CEO and CFO think their financial reporting is pretty solid. They have a handle on the numbers and are putting them together accurately. So what's the story here? PAMT Corp had a tough year. Revenues were down, expenses were up, and they swung to a loss. They're facing some pretty big risks, especially related to tariffs and customer concentration. They need to manage those risks and find ways to boost their revenue, and they need to make sure they can cover all that debt based on their numbers. It does not look like that will be easier. Thanks for watching. If you enjoyed, please subscribe, like, and comment.